Let me pose a question to you. How can you end up with $1 million? Answer: by starting out with $3.3 million and aggressively buying puts on the most popular stock in the market right now. I present to you Exhibit A, MIA76. Convinced that Nvidia is overpriced, MIA76 is a cautionary tale that reminds us what the true meaning of being an ape is. He YOLO'd, like many before him have, into his contrarian strategy, betting that Nvidia was overvalued and due for a significant price drop. This was 6 days ago, and as of this recording, MIA76 has shown no indication of giving up on this foolhardy mission.
Alright, Brain. You don't like me and I don't like you.
But why would MIA76 YOLO this hard? Well, we have a bit of a glimpse into their mind. I found a post where they argued that H100s were oversaturated, making it cheaper to rent these units rather than buy them. This opinion was not shared by everyone, and MIA76 found their thesis viciously assailed by fellow travelers in the Wall Street Bets subreddit. You can decide for yourself who you think is correct, but I wouldn't bet too aggressively either way. If you're watching this video, you're probably someone with an interest in finance and investing, so you may have seen the movie The Big Short. If you recall, the movie dramatizes well-known contrarian value investor Michael Burry's misadventures as he pulls all the stops to short the bejesus out of the housing market. Basically, after hemorrhaging investor cash in order to maintain his bearish position on the housing market, pissing off his investors along the way,
you motherfucker,
he was eventually proven right. I think this movie has poisoned the minds of many a Wall Street Bets degenerate, convincing them that the path to riches is attained through being a contrarian investor / debate lord and shorting stocks people like, while the market is in the midst of a historic bull run. Could never be me. I'm not Michael Burry, playing with institutional investors' money, nor can I afford to get hammered by massive losses month after month while waiting for my absurd fantasy of Nvidia collapsing to play out before I run out of money. Don't swim against the tide. Think market valuations are crazy and out of control? You're probably right.
Attention all personnel! The Black Death is coming! The Black Death is coming! The great pestilence is finally upon us! Repent! Repent!
But being right doesn't make you money. Instead of being a contrarian who weirdly prides themselves on how much money they're losing, while calling the people who are making money by holding popular stocks and PCs, you can do a few things to profit off the ride up without overexposing yourself when and if the big one finally comes. You're going to want to position size accordingly. This, in combination with surgical strikes diversified across time, mean that you'll be able to get in and out of a position, profit off capital appreciation, and get the hell out of there with your tendies. Entering and exiting the market using 30 to 40% of your account value can make you less skittish about entering the market and reaping some gains, while overall conditions appear to be frothy. For example, let's say you have an account value of $15,000 and you decide to sell puts on Square, which is currently trading at about $83. Let's say you manage to sell 5 puts against Square, netting you $1,250 until Square's share price suddenly tanks $10. This means that you've eaten a $1,000 loss, which has been offset by the $1,250 you've collected in option premium. So over the course of 5 months, you'd be up $250 on, we'll call it $8,000 in collateral. Basically a 3% return in 5 months. Not great, but still better than just losing $1,000 had you bought Square the day before it tanked, every value investor's worst nightmare. This is how diversifying your entry points over time is an effective hedge against market volatility and can even beat out a simple buy and hold strategy. This is a simple example, but by continuously entering the stock, generating option premium each time, you reduce your risk exposure. By the way, I think Square is a tad overvalued at $80, so this isn't a recommendation to go out and buy it. I'm just using it as an example. But in the meantime, I suppose the lesson is this: run with the bulls. If the market suddenly does tank, forcing you to eat some losses, you can pull out some capital at that point and reassess whether or not it's happening frequently enough to justify aggressively buying puts. But don't be a silly goose like MIA76 and buy puts on the most popular stock in the market in the middle of a bull run. That's just foolish. Like any option, buying puts shouldn't make up the majority of your portfolio. Options are depreciating financial instruments. You can be right about the fundamentals, but once you press that little buy button on your screen for those puts, the clock starts ticking, and you now have a finite time to go from being right to having the market do what you want it to do, on pain of losing your whole ass. Think of it this way: buying puts in the middle of a bull run is like going to the running of the bulls and then deciding to turn around and run the other way in the middle of the action. It's just not going to end well. Heed these warnings or you'll end up like our friend Maye76. And I don't mean a millionaire, I mean losing 2/3 of your account value. But Maye76 is not the only one. There's been quite a bit of degeneracy afoot as of late, and the perma-bears are mounting a revolt against the norms. One Wall Street bets ape, attempting to diagnose themselves, toyed with the phrasing perma-bear syndrome. However, this diagnosis misses the point, as one commenter pointed out. Lost Invite, they said, wasn't a perma-bear, but rather a contrarian investor who would start buying calls were the market to start sinking. Could never be me, folks. The lesson is simple. Again, run with the bulls and do something else with the bears. I don't know, get out of the bear pit and watch them play. Most investors bet on stocks going up, so if you're buying puts, you really have all your work and DD ahead of you. This sort of strategy is not for the faint of heart. Actively shorting the markets is different than hedging by using gigabrain, theta gang approaches like selling calls and puts, or taking a reasonably sized short position using puts. Like I always say, if 50% of your portfolio is made up of options, there's a high probability of you ending up behind the Wendy's dumpster, because half of your portfolio has the potential to go to zero, literally overnight. That's why, if you're someone who likes to buy rather than sell options, you should make your positions small and diversify them across time, so that if there is a sudden swing against you in the short term, you've got some further dated options that will be less impacted by such a move, and which will have more time to recover, allowing you to be patient as your thesis plays out, whether that thesis is bullish or bearish. Buying call options, or put options, is a high conviction play. I know it doesn't seem like it for most degenerate Robinhood traders, but it really should be, because like I said before, it's not enough just to be correct. Here's a fun example. Let's say you know for a fact that the CEO of a company you were invested in were to suddenly drop dead, and no one else had access to this information, just you. Armed with this secret knowledge, you decide to YOLO your life savings into put options on that company. If you watch my channel, you already know how this is going to turn out. Not good. Why? Who knows why? But if you ask me, I think the market decided that United Healthcare CEO getting murked wasn't a big deal, because the company can easily replace him with another monster who will continue to deny your bitch-ass coverage. The lesson is, don't be a contrarian, because it doesn't matter if you're right. What matters is when a dark cabal meeting on a golf course somewhere decide to sell the fuck out of the stonks market and destroy the economy. And since you haven't completed the blood rituals, you'll never know when the death stroke is due to come. So we may as well enjoy our lives and run with the bulls in the meantime. Remember, when it comes to stocks, sometimes being a norm is good. Sometimes it is a popularity contest, but you should still be vigilant, because the sword of Damocles is at all times dangling precariously above our heads. And on that happy note, if you enjoyed this video, don't forget to smash the like button, as the old saying goes, and subscribe for God's sake. This crap is not as easy as it looks. I will see you in the next one. Bye for now.